Okay, at least one. Great. So then I would want us to just look at some highlights here. I would want us to look at some highlights here. And this is a question that I want us to take down. Yeah, it is a question, in this case, that has got direct costs. And I got one from the intermediate level. These are questions that I got from the intermediate level. You know, I have to teach things which are different from what we have in the videos. So this one has what we call direct costs. Those expenses that are paid at the beginning in impairment. Okay, great. Okay, great. So in this case here, those scenarios where you are told, for example, in the lease, you are told in the lease that we had, just a moment, writing. In the lease, you are told that we had some direct costs which were paid upfront. Direct costs which were paid upfront. For example, direct costs in this case here, where, all right, when you're never entering into a lease contract, there will be like legal fees. Legal fees. I mean, a contract has to be drawn. All right. So those legal fees, and how do we handle them? So welcome to this session. And I would want to dictate the question. It's quite a short one. So I'm dictating the question. On 1st January 2019, Breakwood Limited entered into a contract to lease an item of plant. You're writing there that on 1st January 2019, Breakwood Limited entered into a contract to lease an item of plant for a 3-year period. So in this case here, N is 3 years. N is 3 years. Thank you, Abby. I hope now you are able to see it very, very clearly. So in this case here, the lease commencement is 1st January 2019. Number of years are how many? Number of years are 3. So we have here 1st January 2019. The lease period is 3 years like that. Now, the terms of the lease is that Breakwood would pay Kenya shillings 500,000. Would pay Kenya shillings 500,000 per annum. 500,000 per annum for 3 years. For 3 years. Commencing on 31st. Commencing on 31st December 2019. So what type of a lease is this? Is this lease payment in advance or a lease payment in arrears? Is it lease payment in advance or a lease payment in arrears? Because that is really, really important for you, especially this time. Yeah. So will this be lease payment in advance or lease payment in arrears? In arrears, because you can see our lease is commencing on 1st January 2019, and we'll be required here to make the first payment at the end of the year. So these are lease payments in arrears. So tell us there that initial direct cost in the card were Kenya shillings 30,000. Initial direct costs in the card were Kenya shillings 30,000. So we are told in this case here that the useful life is 5 years. So you can see, ladies and gentlemen, the lease life is 3 years. Useful life of the asset is 5 years. All right. So between the two ages, which age am I going to use for purposes of depreciation? for purpose of depreciating this leased asset, the lower. So between the two, so in this case here, the depreciation lifespan will be 3 years here. So whenever you're told, at times you can get like a tricky question. You are told in this case here that the lease life is 10 years. I would have preferred to depreciate this asset over 10 years, over the lease life. But what if in this case here that the asset you've leased may not finish your lease? What if later on you discover that the economic life in this case of this thing is 8 years? So you shall always compare the two, and you shall always use the lower duration for purposes of depreciating your leased asset. That is an area where the examiner can flip you. In this case here, you get a fail very, very easily. All right. In this case here, Breakwood can borrow at an interest rate of 10%. So borrowing rate is 10%. What do you think are we going to use this 10% for? The borrowing rate, of course, this will be the interest rate, or it will be the cost of capital. So cost of capital or rate of interest, in this case here, is 10%. So cost of capital is what here is 10%. Cost of capital is 10%. Cork, yes. Thank you very much. So Angela, it's a question I'm borrowing from the intermediate level, but if you just copy this, you are good to go. If you copy this, you are good to go. If you copy this, you are good to go. It's an intermediate level question, but very good question, because it has got some things are needed here. Some things are needed, like, for example, the useful life, economic life is different from the lease life. What do we do for depreciation? We should always take the lower. So remember, in the old IFRS standard, I remember IFRS 16 is quite a new standard. In the old standard, this lease year would have automatically been categorized under what we call operating leases, right? Because you can see number of lease years, 3. Out of the total economic life, 5. So can somebody give me this? What is 3 over 5 percentage-wise? 3 over 5 percentage-wise? 3 over 5 percentage-wise? Tell me 3 divided by 5 times 100. Yeah, in the old lease of the weight, so that is 60%. You see, for us to talk over finance lease in the old standard, the lease life ought to have covered more than 75% of the economic life. The lease life ought to have covered more than 75%. All right? But that is the old standard. Nowadays, there is no distinction between operating leases and what year financing leases. There is no lease, which in this case, that will be what year off balance sheet. Off balance sheet. So in this case here, all leases shall be well within the balance sheet. They shall be well within the balance sheet. So what are we required to do, ladies and gentlemen? So we are required here, number 1, to give them the present value of lease liability. Present value of lease liability. And then number 2, we are required in this case to give them the extracted P&L and statement of financial position. Statement of financial position, in this case here from Breakwood. In Breakwood's books. In Breakwood's what here? Books here. Remember, Breakwood is the lessee, is the one who is leasing the asset. Breakwood is a lessee, is the one who is leasing the asset. Is the one who is leasing the asset. All right. So then step number 1, solution. What will be the very first step, ladies and gentlemen, in this question? Now you guys are experts. Step number 1. What will be the very first step here? Step number 1. What will be the very first step? It's IFRS 16, remember. Somebody talk to me. You guys have just told me that you've watched all the videos. Find depreciation? No. That is really far. Discounting, yeah. So actually the very first thing is for us to get this present value of lease what year. So step one, give us in this case here present value of lease liability. And how do we do this, ladies and gentlemen? We shall take, how much are we paying every year? We are paying 500,000. Every year we are paying 500,000. times PV-FA, because this is an annuity, times PV-FA, because this is an annuity. So PV-FA, what is the cost of capital? PV-FA 10%, PV-FA 10%. For how many years? For how many years are we going to pay this 500,000? Are we going to pay this 500,000 for 3 years or 5 years? Remember, 500,000, ladies and gentlemen, will be payable over the lease time. We are paying this for 3 years. We are paying this for 3 years. We are paying this for 3 years. So in some cases, your examiner will give you these annuity tables, but in most cases, your examiner will want you to compute the PV-FA. And we are bright students because we know that PV is 1 plus R raised to negative n. That is PV, the lump sum ones, the irregular one. So PV is 1 plus R raised to negative n. How about PV for my friends? To get PV for my friends, we shall take 1 minus this simple formula. 1 minus this simple formula, 1 minus this simple formula, and then you divide everything by what here? You divide everything by R. To get present value interest factor of an annuity, we shall take 1 minus this simple formula, all right, divided by R. So then this one here will be equal to 1 minus 1 plus R. You see, our R is the cost of capital, is the required return. So our R in this case is 0.1. We divide this, or divide that, I mean, raised to negative, you've told me 3 years. Raised to negative 3 years. All right, and then everything to be divided by R, the cost of capital, which is 0.1. So can somebody in this case here give me this figure here? So you take 1 minus 1.1 raised to minus 3 raised to minus 3 equals whatever answer you get, you divide by R, which is 0.1. Whatever answer you get, you divide by 0.1. So in this case here, everybody must take up their calculator. Everybody must understand this. So I'm being given 2.486 something. 4 decimal places. 4 decimal places, this will be 248.69. 4 decimal places, this will be, so 500,000 times 248.69, of course, with a decimal here. With a decimal here. So then what is the present value? What is the present value of our lease liability? Yeah, so Mauritia, she's giving me 124 something, right? She's giving me 124 something. 124 something. Present value of lease liability. So I've gotten this PV-FA as 2.4869. 2.4869. Thank you so much. So I'm being given a figure of 124, 124, 124, 34, 50, 124, 124, 124. So somebody's getting here 124. Somebody's getting here 124. Remember, you use this, don't use the one that is in your calculator. You take this, the way it is, 4 decimal places, times 500,000. What figure are we getting there? 124, 124, 124. Then we have here 3450, 124, 34, 50 like that. Thank you very much. So we have now known how much we owe this person from the beginning. You know, we don't have enough money ourselves. In this case, we can't build. We can't come up with this, for example, office space at Westlands. No. So in this case, you're going for a lease. So it's like, for example, now the lessor has just given us this money as a loan. All right. And how much are we be paying him on a yearly basis? 500,000. Now that we know the lease liability, the second step, go ahead and pay. Go ahead and pay. Prepare a loan amortization schedule. Go ahead and pay. So go ahead and pay. So prepare a loan amortization schedule. Prepare a loan amortization schedule here. So remember, this is step number what here now? This is step number 2. This is step number 2. You prepare a loan amortization schedule. So over how many years? So remember, we have period here or year. We have in this case here after period. We have here 1, 2, 3. 3 years. 3 years. 3 years. Right? And then of course we're going to have, ladies and gentlemen, here the opening balance, right? You need to have the opening balance. So step number 2, just have your loan amortization schedule. So we have our period here. We have a 1, 2, 3. That's our period. Then we have opening balance. Opening balance. So after opening balance, immediately we normally do the interest. Don't forget this procedure. After interest, we have the installment. We have the installment. After installment, in this case here, we have, we have opening balance, interest installment. Then we have the principal. We have the principal. Then we have the closing balance. Don't forget this. We have the closing balance. We have the closing balance. We have the closing balance like that. We have the closing balance like that. Remember, the lease life is just 3 years. The lease life is just 3 years. This lease life is just 3 years. So please have your loan amortization schedule captured there very well. Have your loan. So in this case, according to Carol, she's given me the answer, which is 120. Let's work on one answer. Let's work on one answer. Let's work on one answer. Let's just use one answer here. Let's use one answer. The person in this case here, for example, who used these 2.4869 4 decimal places times 500,000 here, what is your present value lease liability? The one who used in this case here, the 4 decimal places the way they are there. The 4 decimal places the way they are there. The 4 decimal places the way they are there. 4 decimal. You know, there are those students who normally would use the figure that is in the calculator, which is of course more accurate, but we want all of us to use one figure. Let's all of us use one figure. So for us to be able to use one figure, let's use these 4 decimal places. So the gentleman or the lady who has been able to use the 4 decimal places exactly, we have 124, 3450. So this is what you bring here as your loan balance. 124, 3450. This is what you bring here as your loan balance. 124, 3450. And then now we know that installments will never change. In installments, we have 500,000 throughout each year. Installments don't change. 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 Ladies and gentlemen, we have our interest. Do we know our rate of interest? Our rate of interest is the cost of capital. Our rate of interest is the cost of capital, which is this 10%. 10%. So can you kindly give me 10% of this amount? Remember, this is column A, column B. I hope you remember our columns. I hope you guys remember our columns. I hope you guys are able to remember our columns. I hope you guys are able to remember our columns. So we have this is column A, column B, column C, column D, column E. So remember, to get interest, what do? You take the rate of interest. So this one here, we shall take the rate of interest. So to get B, we shall take the rate of interest, which is 10% times A, times A, 10% times A, 10% times the opening balance, which in this case, it gives me 124,345, like that. Who is able to remember how to get the principal? Remember the installment that you pay. The installment that you pay has got 2 components. The installment that you pay covers the interest and it covers the principal. So anytime you want to get this principal D, you simply take the installment and then you subtract B. You take the installment and then you subtract B. You take the installment here, you subtract the interest. The interest. So it is 500,000 minus this 124. Is there somebody who can give me this figure? So it is 375, 655. So this is 375, 655. Thank you very much. And then we come to the closing balance. Remember, your closing balance can only be reduced by the principals. So anytime you want to get closing balance, you will take the opening balance, you subtract the principal. So to get this closing balance, you will take the opening balance, you subtract the principal. So basically, to get E, you will take A, you subtract the principal, which is D, like that. So anytime you want to get a closing balance, You shall take the opening balance minus the principal. So is there somebody who can give us this 124,3450 minus this 375,655? Is there somebody who can give me this closing balance? Closing balance, according to Bini, it is 867, 795, 867, 795, like that. And then you come and bring this here. Remember, the closing balance of year one becomes the open balance of year two. So this becomes 867, 795, like. Today we want to avoid decimals. In your exam, you will put decimals, but for me, I want to avoid decimals. Today we want to write whole numbers. I want to write whole numbers today. So then come and give me the interest. Remember, interest, you take the cost of capital, which is 10%, times our opening balance. So is there somebody who can see here we have 780, because it's 86, 779.5, 779. So can somebody in this case give me this interest for I want to avoid decimals today. I want to avoid decimals today because of my speed today. My speed today has to be high because of to finish this thing. Must finish this thing. Thank you very much. Well, then come here right away and give me the principle here. How do we get this principle? Principle is the easiest, because I know the relationship between the installment and the principal and the interest. So I know that any payment, any installment that I pay covers interest and covers principal. So to get principal, I will take the installment minus the interest here. I will take the installment minus the interest. I will take the installment minus the interest. So according to Monica, it is 413, 3, it is 413 to 20. 413 to 20. 413 to 120. And then I'll come to the closing balance. I know this is a matter of balances. So to get the closing balance, I'm taking the opening balance minus the principal amount. Opening balance minus the principal amount. Is there somebody who will be giving us this closing balance there? Anybody who will be giving us this closing balance? Closing balance, closing balance, closing balance. So remember closing balance. So we have here 454, 575. So we have here 454, 575. So remember this closing balance is what you bring here. Closing balance is what you bring here. 575. 575. And then you give me a whole number here in terms of interest. So to get interest, interest is always based on opening balance. Is always based on opening balance. So you have 10% times this, 10% times this. So we have here 45, 458. So we have here 45, 458, 45, 458. So then come and give me the principal amount. How do we get the principal? We shall take here the installment minus this interest. Installment minus this interest. Installment minus this interest. How much do we have? So we have here 45, 454, 454, 454, 454, 454, 542, 542, 542. And then of course we know that to get closing balance, ladies and gentlemen, we shall always take what minus what? It is opening balance minus principal. I know you will get some error here, but of course we are not that dumb. Ourselves, we are very, very good. We know that this is supposed to be ending on the third year. So if it's supposed to be ending on the third year, the loan, total loan, so the loan has to be amortized. So the loan will be equal to exactly what year? The loan will be exactly equal to 0 like that. So are we together up to there, ladies and gentlemen? 0. Even if you don't get a 0, you must write a 0 there. Because whatever figure you get relative to the millions is very, very small. It's very, very small. It's very, very small. It's supposed to be 0 like that. Now, ladies and gentlemen, having gotten in this case here, this particular loan amortization schedule, I know my next step. My next step is to look at what we call the right of use. So my next step, ladies and gentlemen, is to look at what we call the right of use. My next step is to look at what we call the right of use. So come here, step number 3. Now we are on step 3. Give us what we call the right of use. So then how do we get this right of use? To get right of use, you will take the present value of lease liability. Present value of lease liability, which in this case here is 124, 34, 50. Yeah. So in this case here, you will come and add, because I want to introduce something new today. You will come and add, in this case here, any payments on commencement on lease commencement date. On lease commencement date. On lease commencement date. Any payments on this lease commencement date. So this could be what here? This could be the direct cost, like the lawyer costs. At times, in this case here, this guy may want you to pay him his lease liability in advance. Here you're paying in arrears. So basically, this will be the direct costs. This will be the direct cost. So do we have any direct cost in this question? Yes. They told us in this question, the direct costs were what here? Were 30,000. Yes. The direct costs were 30,000. We don't have any other payments at commencement of the lease. So then come and give us the total. So this total becomes our right of what here? Our right of use, which basically will be the leased assets. Which will be the leased asset. So is there somebody who is able to give us this figure very fast here? If you want to understand something, isn't it? Right? Be 127, yes, it will be 127 and 450. Thank you very much. Yeah, 127, 34 what here? 50. Thank you so much. So now having gotten this right of use, then what do we do straight away? We depreciate, isn't it? So we depreciate. We depreciate. So in this case, here give us depreciation. Depreciation per annum. It will be this 127, 3450 over the lease life or economic life, whichever is lower. So remember the lease life here was 3 years, the useful life was 5. Whichever is lower is what you use to depreciate your asset. So divide by 3, I want a whole number answer. You guys in your exam will write like 2 decimal places, but for my case today, I'm only writing whole numbers, whole numbers. Whole numbers, whole numbers. I'm only writing whole numbers, whole numbers. So divide by 3. So what are we getting? 424. 483, 424, 424, 424, 424, 483, 424, 483, 483 like that. And then now we go to the final phase. Final phase is where we look at the impact of our lease on our income statement and on our balance sheet. So first, we shall do an extracted profit and loss account. So extracted. So this is step number 4. Extracted profit and loss account. Extracted profit and loss account. So this is step number 4. I don't know how you're naming them or how you're numbering them. I mean, we should be able to overcome. So how many are we doing that? Sorry. We finished. That will be very fast. I'm assuming like we are at the same level because I'm making an assumption that you guys have got the LMS and watched the videos. That will be wrong. It will be a wrong hypothesis. But have you been able to write up to here? Have you been able to write up to here? And are you understanding? You must understand. You can't wake up this early in the morning and then you fail to understand. If you're not understanding kindly, then ensure you are feeling free to ask questions. You're feeling free to ask questions. All right. So come here and the givers, ladies and gentlemen, are extracted the P&L. So we have in this case here our periods. We wish you can just write 3 years. 1, 2, 3. You can also use those years given there. Right? So then we have in this case here extracted the P&L. Of course, we don't have any income here. Here we only have expenses. Expenses. The first one being the interest expense. The interest expense. Interest expense, you have it here. From this table, from the loan amortization, year number 1, you are paying 124, 345. 124, 345. Year number 2, you are paying 86, 780. Year number 3, you are paying 45, 458. Which other expense do I bring here? Which other expense do I bring here? It's normally a free mark, really. Which other expense do I bring here? Depreciation, thank you very much. Depreciation, which you guys are given me a figure of 484, 483, 484, 483. That's the figure you give me per annum. And of course, for leases, our depreciation will always be what here? Will always be straight line. So the same amount throughout. The same amount throughout. 484, 483, 484, 483. Don't start adding nothing, eh? 424, sorry, it's 424. So 424, sorry for that. 424, don't know where I got 424. Thank you very much. That is the end of the extracted profit and loss or extracted income statement. And then we have our extracted statement of financial position. So we have our extracted statement of financial position. Extracted statement of financial position. So hapa ndio kuna mambo. Lakini si normal, sio normal. Because tunaanza na tuko na asset yetu. So remember we are looking at this thing from the lessee's perspective. The lessee now owns an asset known as right of use. Yeah. So we have here, year 1, year 2, year 3. Is there someone who can remind Mwalimu what the right of use value was? Is there anyone who can remind Mwalimu what the right of use was? Right of use. Anybody who is able to remind Mwalimu the figure? Right of use. It was 127, 34, 127, 34, 127. Moniko umesahau kitu kidogo hapo wewe. Mbona unaka 30,000 kaliongezwa. Umechukua ile bado ni 127, 34, 50. 34, 50. Remember these are times zero. So we expect this asset to lose value. So on the first year we lose this depreciation. So to get year 1, say minus 424, 483. Give me a whole number here. Give me a whole number here. Give me a whole number. Thank you very much, Taylor. Yeah. So then at the end of year 1, according to Masqui, it is 84, 848. 848, 967. Can somebody else confirm this figure? It's only Masqui who has been able to give us this figure. Somebody else confirm that figure. Depreciated asset at the end of year 1. At the end of year 1. Confirmed. Thank you very much. Let it again lose the same amount. It's losing the same amount the whole of year 2. So then what is the closing value at the end of year 2? So this minus this. So we have this minus this. What are we getting here? End of year 2. End of year 2. According to Igamba, it's 424 matter as well. 424, 484. 424, 484. So let it again lose this amount in the last year. Of course, I can see 1 shilling. If you write 1 shilling there, you will be very, very, very wrong. You're the person to cry now. We know that this asset has to depreciate to what year? To 0. Has to depreciate to 0. So write 0 there. You write 0 there. You can't write 1. You can't write 1. You can't write 1. So is that okay, ladies and gentlemen? Is that okay, ladies and gentlemen? Now from there, we go to the liability section. So we go to the liability section. So liabilities, we have non-current liabilities and the current what year? Liabilities. So we have non-current liabilities and the current liabilities. So go ahead in this case here and do what here and help Mwalimu now here. Now you are helping Mwalimu here. Now you are helping Mwalimu here, ladies and gentlemen. We have our extracted statement of financial position, our extracted statement of financial position. So of course we have here the assets. Assets, you guys have killed this one, right of use. We have 1, 2, 3. Here we have 848, 967. Here we have 424, 484. Here now we have 0. From there we go to liabilities. So on the liabilities, I have 2 of them. I have in this case here what I call non-current liabilities. So we have what we call non-current liabilities. Non-current liabilities, and then we have current liabilities like that. So we have here the lease liability or lease obligation. Lease obligation. So is there somebody who is able to remind us? So where are we going to get this non-current lease obligation from this table? from this table, Thank you so much, Igamba. So in this case here, from the lease table, Igamba is telling us something very, very important. From the lease table, or rather from this amortization schedule, to get the non-current liability. Non-current liability, you shall always use the closing balance. Hapa ametuambia kitu ya muhimu sana. Amesema mwalimu, got the closing balance, don't pick the first figure. Don't pick the first figure. We normally pick from year 2. We normally pick from year 2. So year 2, we have here 454, 575. Here we have 0. And then we have 0 there. And we explained this very well. I don't want to get into, in this case, into the situation of explaining again. Remember we said non-current means more than a year. More than a year. All right. How about this current liability? The current liability to some gani? Current liability to some gani woye? Yeah, principal amount. So you read the principal amount again from year 2, remember, second year. So principal amount, second year, we explained this very well. In an exam, you don't have that, the more you cram some things in an exam, the better. So 454, 542, 0 like that. So that marks the end of that particular question. So remember, there are 2 ways of doing this. In the videos there, I showed you some other way. And now I've shown you a new way. So now it's upon you to look at the 2 ways and say, hey, this is the one that I die with. So now I leave that decision to you. So can I go to the next question in class? Yeah. Can I go to the next question? Now, this is the question that I expect these guys to give you. For so long, we've been discussing about this, and they have never brought this to you. So this is the kind of question that I expect these great people to hammer you with come December. Yeah. So where we have lease payments in advance, lease payments in advance. I remember this really is the normal thing. Somebody told me, manyumba tunaishi, ati kwamba unalipa ndio naishi. Ama yuko mwenye anaishi kwanza alafu analipa mwisho wa mwezi. See, all lease tenancy payments in Germany here are normally paid in advance. Ama namna gani? Kwa tunalipa in advance. Rono is asking a question there which I've unfortunately rubbed there. Rono, there is a video in the LMS. Maybe I sent you that video, Rono. Because already now I've changed the gear. I wish you put up your hand very fast before I rub. I would have explained. Rono, just forgive me. And then there is a video. There's a video I've done very well, which you'll be able to go and look at in the learning management system. Remember that learning management system is an engine. Like, there is somebody who called me yesterday from this morning class. Already even this guy has done up to IFRS2. He has done share-based payments. All right. So he was just asking a question on share-based payments. And then I said, wow. Then this learning management system, in this case here, done by RCM, is a great tool. Are there many students in this case who have started really going ahead? Because like after we do the first topic, after we finish the first topic, my next topic is group consolidation. You know, in AFR is the easiest paper to pass. Why? Because you're assured of group consolidation and group cash flows. So I like in this case here doing these group consolidations and group cash flows quite early. So once I finish this topic on assets and liabilities, we were looking at the various IFRSs, I would want to go and do the group consolidation and the group what year cash flows, we put that one aside. So they can know that by bare minimum, we have 40 marks. So then I would want to guide you as you watch those videos. After you finish topic number 1, please look for group consolidation and start watching them. Start watching those videos for group of group consolidation. Yeah. So please, we must create time. I know we are busy. I know we are busy at our workplaces. We are busy. But you see, ladies and gentlemen, life is all about sacrifices. It's all about sacrifices. Like when I woke up today and I realized that for the second day I'm going to bounce a class because of electricity, what did I do? Just woke up and came to the studio. So I woke up at about 4, and now you're at the studio. All right. So life is all about what your sacrifices, trust you me. Because remember now, we have started talking about what you're changing the syllabus. Changing the syllabus. Now we are changing the syllabus. From 2026, I think August. All right. 2025, August, that August sitting, or 2026 January sitting will be a new syllabus sitting. Please don't buy your time. You know that whenever we have changes in the syllabus, students are normally affected negatively. They're normally affected negatively. If I were you, I would ensure that every time I'm passing now my exam, so that I can clear this exam under the existing, what you said, syllabus. Under the existing syllabus. The 2021 syllabus now is coming to an end because normally we give it how many years? 5 years, actually 4.5 years. 4.5 years. Now we're revising the syllabus. So please don't be a culprit. Even if you're a little bit lazy, of which I know there is no single mind who is lazy, we must make a resolution that you're passing this semester. Every semester you're passing. Every semester, because you do a slight mistake. You get a fail, postpone one semester. That's what students do, unfortunately. They fail, they postpone one semester, and then the new semester now, or rather the new syllabus catches up with them. So no failing, no postponing. We have to clear. And the very best way of doing this is through the learning management system. Learning management system. Yeah, you see, like now, these are the changes that they have already put up. Like, you know, management accounting is a compulsory paper. Everybody must do management accounting. Everybody must do management accounting. Videos are impairment. Already videos are impairment. They're there. We need this book I sent to you. I mean, you have not gotten that book. You have not gotten that book. You haven't gotten that book. Then somebody should be able to share that book. Somebody should be able to share that book. That book, I shared it in the book. I shared it in the book. Yeah, it's an ACCA book that I use often, and the UX examiner loves those ACCA questions. Like last semester, I can show you like this question was an ACCA question. UX examiner loves the ACCA questions. So then I'll be able to reshare, but most importantly, yeah, even those impairment, but I will be able to do what here. Oh, okay, I'll be able to share this. I'll be able to share. I'll be able to share. So let's get now working here. So mention their exercise. We are doing an exercise. I told you this is an area that I'm really prospecting this semester, which is very, very good. So we are told here, ABC limited. ABC limited. And that into a 4-year lease agreement. Into a 4-year lease agreement. Into a 4-year lease agreement. Commencing on 1st January 2019. 2019 full stop. The terms are 4 payments. The terms are 4 payments. The terms are 4 payments of 50,000. Of 50,000. Commencing on 1st January 2019. So these are payments in advance. You can see we sign up a lease contract like this, and then we are required to pay the 50,000. So you're starting, the agreement is commencing on 1st January 2019, and then of course you are commencing to pay. So these are payments in advance. Payments in advance. So the COC is 7.5%. 7.5%. And then they have given us the present value of lease liability. The present value of lease liability is 130,026 is 130,026. And then we have here legal costs, legal costs, legal costs, legal costs to set up the lease were 402. What I no figure, but let's just do it the way it is. 402. And then we are required, number one. Number one, loan amortization schedule. Loan amortization schedule. And then number two, P&L and statement of financial position, extracts. The loan amortization schedule, and then we have here P&L stroke statement of financial position, extracts. Statement of financial position, extracts. Statement of financial position, extracts. Yeah, let's concentrate here. We already have been told there is a question of that in the WhatsApp. Let's concentrate. This is quite a sensitive area. You can't mix this with so much. So once you guys finish writing this up, can you put your thumbs up like this? Take a few minutes here to do what here. Take a few minutes here to knock this down, and then you can talk about. All right, great, done. So then, gentlemen, if I'm the one doing this kind of a question, first of all, I would want to test this present value of lease life. So I'll just follow those steps the way they are. So there are too many ways of doing this present value of lease life. It has been given, but there are many ways. I want to show you next time it will not be given. All right, next time it will be given. No? So you see, these are 4 installments. So we have here 2019, or 2020, 2021, 2022, like that. So we have here the leases paid. So here they pay 50,000, 50,000, 50,000, 50,000. So the gentlemen, remember, this 50,000 now is going to be paid upfront. So by the time we are measuring our liability, this figure has already been paid, because we're going to measure our liability here, and this is the very date that we have paid. So this will not be there. This will not be there. So then if it won't be there, then how do I calculate this present value of lease liability? So there are many ways of doing this. So the present value of lease liability, in this case here will be the annuity, 50,000. You multiply this with PV. We have the cost of capital, which is 7.5%. But now we say N-1 because there is one installment that has been paid. There is one installment here that has been paid. One installment that has been paid. Yeah, the lease in advance. Remember, we have lease in arrears and lease in advance. Good question. So lease in arrears, for example, you have signed this contract here 1st January 2019, beginning of the year, but your first installment will be paid at the end of the year. You'll pay the first installment at the end of the year. That is lease in arrears. Yani unaishi ndio ulipe mwisho wa mwaka, mwisho wa mwezi. That will be lease in arrears. But there are those situations where you have to pay fast. And then in this case here, you enjoy the services. That's a payment in advance. And most of the leases really are paid in advance. Most of the leases really are paid in advance. Like now here, we are going to commence the lease on 1st of January 2019. And you're told here the terms are 4 payments of 50,000 commencing on this date. So we are basically paying the first installment on the commencement date. So then this is a lease being paid in advance. And the examiner can really hide. Like this examiner never told that the lease is being paid in advance. It was upon you to read in between the lines and see that we are beginning this lease today, 1st January 2019, and we're required to make a payment today. So they are called upfront payments or in advance payments Thank you very much. Thank you very much for asking. So now I'm trying to explain here to get present value of lease liability. So remember here we are taking this lease liability. This is paid at the beginning. It's paid on 1st January. So by the time we are measuring how much do we owe this gentleman, the landlord, how much do we owe him? By that time, we already paid the first 50,000. You first paid the 50,000. So then let's get here. So 50,000 times PV for 7.5, n minus 1. So number of years are 4 minus 1. That gives us what here? 3. That gives us 3. Great. Great. So then we'll let know what we have over here. So what we have over here, my present value of LL, lease liability, will be 50,000 times PV for 7.5%, 3 years, because of n minus 1. So come and give me the PV file. How do we get this PV file? It is 1 minus 1 plus R raised to negative n, everything to be divided by R. So that this one here will be 1 minus 1 plus 0.075 raised to negative 3. Raised to negative 3, all over what here? All over R, which is 0.075. This, so many students in an exam will write this as if it's 0.75. You can even use your calculator. 7.5% divided by 7.5 divided by 100 will be 0.075. So you go slowly here. Say 1 minus into bracket 1 plus this close. Then you raise this to negative 3. You raise this to negative 3 and then you say equals. You raise this to negative 3 and then you say equals. Whatever answer you get, you divide it by 0.075. Whatever answer you get, you divide it by 0.075. So in this case, we're getting 2.6005. 2.6. How I wish everybody was able to get this value. 2.6005. But what Ronald is getting there, full number. And then I'm going to take this one here and take the 50,000 times whatever answer you got there, which is 2.6005. So is there somebody who is able to give us this present value of lease liability? Is there anybody who is able to give us this present value of lease liability? Is there somebody who is able to see 130,026? And this 130,026 is very, very familiar. It was given in the question. Or 130,025, isn't it? 130,025, but now you have to write the one that is in the question. Yeah, to show that we write the one that is in the question. So it is 130,026. It is 130,026. 130,026. 130,026. 130,026. Another student will tell you, Mwalimu, no, we don't want that method of money. Another student will come and tell you, Mwalimu, the method that we did when we were doing financial management, method 2, when we were doing financial management, is the one where we say present value of lease liability because of the in advance payments. Come and take 50,000 times PV FAR, 7.5%. Work with 4 years normally. But now because it's advance payment, come and introduce this concept of 1 plus R. Multiply by 1 plus R. Introduce the concept of 1 plus what here? 1 plus R. That will give you the same answer. But now remember, this total liability will be having that 50,000 in it. So then whatever you get, you have to subtract 50,000. Whatever you get, because that 50,000 has been paid. Let's first of all do this. This 1 plus R takes care of the advance payment. The 1 plus R takes care of advance payment. So then let's first of all do this thing here. This PV FAR, that's the only complicated thing here. So we have PV FAR 7.5% 4 years. 7.5% 4 years. Then what we have, ladies and gentlemen, here, this will be 1 minus 1 plus r raised to negative n all over r. So then this will be 1 minus 1.075 raised to minus 1. So here you don't use n minus 1. Here you don't use n minus 1 divided by 0.075. Are you able to give me this figure? Are you able to give me this figure? Yeah, they're saying 130,025, which is very good, Taylor. 130,025, which is very good. But remember, in the question paper, we were given 26. So we shall not fight because of one box. We can't wake up this early morning to fight because of 1 shilling. I'm 100% sure that it shall be 130,026. That's what we write. That's what we can use in our loan amortization schedule. Nimeandika chini sana. So this method, ladies and gentlemen, so I'm getting the PV for here. So the PV for here will be, so we have here 1 minus 1.075 raised to minus 4, all over 0.075. So is there somebody who already has gotten this answer? And I wish everybody was really computing. So according to Sabina, according to we, it is, okay, so it is 3.3493. I'll be able to repeat there, 3.3493. So it is 3.3493. That's PV. Then come and apply it here. Apply it here. So present value of lease liability. So it will be 50,000 times, in this case here, this 3.3493 times 1 plus R, 0.075. Is there somebody who is able to give me this answer? Is there somebody who is able to give us this answer? So you introduce this 1 plus R simply because of what here? The advance what here? The advance payments. I'm so sure you haven't multiplied. You haven't multiplied with 1 plus R. We must multiply with 1 plus R. We must multiply with 1 plus R. But here, multiplied by 1 plus R because of what are the advance payments. Because of the advance payments. So we have here 180, 026. So we have here 180, 026. But now remember, you must come and less the 50,000 paid upfront. You less that one. You get the lease liability. So therefore, the present value of lease liability will be 130.26. Because remember now, if you're using this approach, you're getting the total liability. But remember, the 50,000 has been paid up front. So you subtract it. The 50,000 has been paid up front. You subtract it. So you get 130,026. 130,026. We adopt method what here? We adopt method 1. But you see, I have that. I mean, I know most of the students from your section 3, most guys are asking me, what about that formula of 1 plus R? What about that formula of 1 plus R? Right? So then we shall stick with method what here? Method 1. We shall stick with method 1. So then somebody has told me to repeat this method 1. So method 1 is quite straightforward. So remember, under method 1, you will simply come and give us present value of lease liability. You take 50,000, you're paying this every year, times PV. We have here 7.5%, and then N minus what here? N minus. Remember, N is 4 years. N is 4 years, right? So 4 years. So we have in this case here 4 minus 1. So then this will be the same as 50,000 direct method times PV for 7.5%, 3 years. So your role is to give us just this. PV-FA 7.5%, which will be 1 minus 1 plus R. Raised to n now, our n now becomes 3. Right? Because already we have taken care of the n minus 1. Right? 0.4. So 4 minus 1. So divided by 0.075. Can somebody give me this figure we got here for PV-FA? Just a reminder for PV-FA. What do we have there for PV-FA? Somebody? At 2.6005. 2.6005. Then come and give me the PV of lease liability, which will be 50,000 times 2.6005. All right. For the students who are following me on YouTube, I would first of all request that you subscribe to my channel called Joshua Aura. Right now it has 28,000 followers. So like even the guys who are with me, morning class here, Zoom class is 70. You go, all of you subscribe that channel and get 70 people. That's a big number in a day, right? And of course, those ones who want to join us, don't hesitate calling us. Our number is 254. Then we have 0790 525,000. That's our number. You need to join us. All right. So this is going to give us 130, 020 what here? 130, 026 as the present value. Lease liability, present value of lease liability, which is very good. So Rono, I think you're not following very well. We are going, at times we may get answers which are quite different. I think you can even get like 130, 023. But if the examiner has given you a number there, if the examiner has given you 026, how you use 026? I hope you're together, all of us, as regards that. Because I don't want you to have in your model schedule, I don't want you to have 025. Because the examiner has given us 026. Let's agree first of all on that. But at times you may get answers because of the random of errors. Answers which are fine. You can even get 130 or even 129,000. Don't write 129,000. You write the figure that the examiner has given, because the examiner may have rounded off to the small. You should always write the figure given by the examiner. How that is clear, and all of us in the model schedule, we're using what the examiner gave us, which is 130, 026. So that is step number 1. Actually, we would not have even computed it because it was given by what here. We should not have computed it because it's given by the examiner. What we should have done straight away, once I'm given the present value, this liability, I should go ahead and amortize. So mention there loan amortization schedule. Now this is where so many students, 99.9%, will get to 0. Because the loan amortization schedule for advance payments is totally different from the loan amortization schedule of in arrears payments. So this is what we shall do. We have our years here. We have our years 1, 2, 3, 4. Of course, you're going to have opening balance. Opening balance will be there. So you're going to have opening balance. You can just write save space. So we have years. So years 1, 2, 3, 4. So we have our opening balance. So remember here, we start straight away with this opening balance and then we pay because you're paying. So then the installment paid comes here. Installment paid comes here. And then we shall introduce a new column called balance due. Balance due. And then I shall be able to have our interest. And then lastly, closing balance. Let me know once you guys are able to draw this. This is a very, very important table, and we use it whenever we have, in this case here, payments up front. payments in advance, payments in advance, payments in advance, payments in advance, payments in advance. Once you finish drawing up to there, please put your thumbs up like this. Like this. So you start with opening balance, but you remember you pay immediately. You pay immediately. Joyce is saying like this. Thank you so much. So then how much are we paying? How much are we paying? How much are we going to pay? Listen and listen to me very well. And this is where students confuse totally. This is where students confuse totally. So then what is our opening balance? Our opening balance is 130,026. 130,026. So we have here 130,026. How much installment are we going to pay here? How much installment are we going to? 0. This is Samuel. Somebody must be very bright. You must be very bright. Because so many students in this case will come and put 50,000 here. Forgetting that for the first year, this figure is net of the 50,000. This figure is net of the 50,000. Because the rate was supposed to be 180. And that is why when I showed you using the other method for you to understand it better. So here, already the wameng'oa ngapi somebody washaamua. So hapo using'oe tena. Uking'oa tena, international disaster. Uking'oa tena hapo international disaster. Washaamua. Haya. Sio makosa, Monica, many people do that. So then the balance due here will be 130,026. 130,026 like that. That is the balance, 130,026. So this interest now, I hope interest was 7.5. So the interest here now will be based on this balance due. So 7.5 of balance due. 7.5 of balance due. 7.5 of balance due. 7.5% of balance due. So is there somebody who is able to give us that answer? Anybody who is able to give us that answer? 97. I would prefer, in your case, you guys can write decimals, but me, I don't want to write 97.52. In your exam, write like 2 decimal places. In my case, for demonstration and my age, I need to simplify things now. So come and give us closing balance. You take the balance due plus interest. Balance due. If we take this as our column A, column B, column C, column D, to get closing balance, we shall take C plus D. C plus D. Closing balance, we take C plus D. We take the balance due plus now interest earned, interest accrued. What do we have, ladies and gentlemen, now? What do we have, ladies and gentlemen? 139,778. 139,778 like that. So now this is your opening balance. So opening balance, you have 139,778. Now here you will pay 50,000. You will pay 50,000, 3 of them, like them. 3 of them. Yeah. So please don't let me down in this exam. If it's payments in advance, never forget the first one here is 0. If you forget that one, international disaster. So then please go ahead and give me the balance due here. So 139,778 minus 50,000. What do we have there? Now you can move with speed. So 89,778. How I wish that an angel could just find these figures, give them to me very fast. So 7.5% of 89,778. Give me what figure? 67.33. 67.33. Please go ahead and add this, the balance due, to the balance due. Add that to the balance due. Thank you very much. Must we? So we are getting 96 what here? We are getting 96, 511. So here, even if I move with speed, I'm so sure you guys already, the concept is all 96,511. 96,511. So remember, this is supposed to be a deductible, eh? It's called my big, it's supposed to be deduct, eh? Now, to get balanced, you is supposed to deduct this. All right. So then go ahead and give me this figures and gentlemen. Go ahead and give me this figure. This will be very easy. 46, 511. So we have here 46, 511. Thank you very much. Thank you very much. How about the interest thereon? The interest thereon. The interest thereon. 3488. 3488. To this 3488, added to this one, then you'll be able to give me the closing balance. 46,511 plus 3488. Then you'll be able to give me the closing balance, which is 49. A beautiful figure there. 49,900 something. 49,900 something. So this is what we're doing. 49,900. When you subtract this now, don't tell me that we're getting negative one. Where? What are we getting here, somebody? What are we getting here, somebody? We know that this thing should cancel out, isn't it? So it should be 0, right? So we have what here? 0. So balance due plus interest, what we have there lastly? 0 like that. 0. Everything becomes 0, 0, 0. Ukiweka that -1 kata kumess. Ukiweka -1 kata kumess. So are we together up to here, ladies and gentlemen? Are we together up to here, ladies and gentlemen? Yeah, cause of rounding off, yes. Cause of rounding off. Cause of rounding off. Don't look for perfection. Don't look for perfection. If you want perfection, then put all the decimal places. So then that is it. So then what I would want us to do is to come and go to the, what will be the next step? After loan amortization schedule, what will be the next step? After loan amortization schedule, what should be the next step? After loan amortization schedule, what should be the next step? Depreciation? No, it is ROU. Although I know what you're trying to talk about, but the next step here should be ROU. So come and give us ROU. So give us ROU. So for you to get ROU, give us present value of lease liability, which was 130,026, and then you add payments made at commencement date. So payments made at commencement date, there are 2 of them. Payments made at commencement date, there are 2 of them. Which ones are these? Don't forget the first installment of 50,000 was paid here. Don't forget that you also had some lease setup cost, legal setup cost. The legal setup cost was 402. 402. 402. So it's only 54. 402. This is the total ROE, right of use. So you take the present value of lease liability plus any payment that was done at the lease commencement date. And at the lease commencement date, we paid our first installment of 500,000, and then we had some fake lawyers there who asked us, maybe the 402 maybe should have been stamp duty. It can't be a legal fee, but probably was stamp duty. Stamp duty. So then this will give us at the end of the day 180,428. 180,428. Please go ahead and give me depreciation. So depreciation, I will take, depending on the right of use, I will take that 180,428 divided by 4. So 180,428 divided by 4, which will end up giving me like what Igamba is telling me. Thank you very much, Ronald. There, 180,428 divided by 4 years, remember? Divided by 4 years. This is supposed to be 4 years. So 45,107. So we have here 45,107. So we have here 45,107. So we have here 45,107. 45,107. Thank you so much. So from there, what do you think will be the next step? Now you're guiding me. What do you think will be the next step? Yeah, extract P and L. We extract the P and L out of this. What figures are we going to take to our P and L? Very easy. So extracted profit and loss, or extracted income statement, extracted P&L. So we have here extracted P&L. All right, of course, these are expenses. So we have interest expense. Interest expense, years 1, years 2, years 3, years 4. Interest expense, you can see where interest is. Interest, you can see where it is 97.52. 97.52. We have here 67, 67.33. We have 34.88. We have 0. We have 0. And then, of course, we have depreciation, which unfortunately are brown. Are you able to see the depreciation? The extracts, are you able to see the depreciation? 45 something, 45, 107. Depreciation is very easy, 107, 45, 107, 45, 107, 45. Once you finish writing this extracted P&L, put your thumbs up like this, put your thumbs up like this, put your thumbs up like this, so that I can do now extracted statement of financial position. Thank you so much. I hope I'm not very fast for most of you, but we shall overcome. The good thing is that you guys have understood that. So extracted, because of the size of my space, I need to keep on having. So extracted, statement of financial position. So under extracted statement of financial position, I will always start with the assets. So we have here 1, 2, 3, 4. So we start with the right of use asset. So the right of use was it 180 something? Well, in the rate of use the 180. Right of use the 180 something, right? 180 something, 180 something, 180 something, 184.25, isn't it? So do we have the depreciation amount? Is there somebody who is able to remind Mwalimu depreciation again for the last time? 45 something, 107. 45, 107. So we have here 45, 107. So then at the end of year 1, this thing will be worth how much at the end of year 1? 45, 107. Yeah, Eric, you'll be able to get this recorded video. Yes, you're able to get this recorded video. You're able to get this recorded video. You're able to get this recorded video. Abracadabra. Please give me the first year's end of the year. This asset will be worth how much at the end of the first year? So according to Masqui, 138, 821, 138, 821. Angalia, when kazi unaenda ukitoa depreciation mpaka hii tuishe zero. Unaenda ukitoa depreciation kila mwaka unatoa tu same figure unamoa kwa hii. Because ni cumulative, unaenda ukimoa tu kazi yako ni kumoa, kumoa tu 135, 325, 321. 135, 321, unamoa 45, 107. Moa 45, 107. Moa 45, 107. Wewe kazi yako ni kumoa tu. Wewe kazi yako ni kumoa tu. Kumoa tuone, abracadabra. Wewe kazi yako ni kumoa tu. Year 2 is wrong. My year 2 I'm told you is wrong. Year 2 is wrong. Sorry for that. So year 2 inafaa kuwa ngapi somebody? Year 2 is wrong. Year 1 inafaa kuwa 135, 321. 135. 321. Thank you very much. 135. 135. 9214. So 9214. So this 9214 is more 45107. It's more 45107. It's more 45107. So inabaki 45107. Hata kama kuna rounding off errors hapo unaandika 0. Hapo unaandika 0. Sasa kutoka hapo tuko na non-current liability, what we call the lease obligation. Lease obligation. Sasa hii nayo ina confuse wanafunzi kiasi. If it is in advance, If it is in advance, remember this is in advance. If it's in advance, always you talk about closing balance or year. If it is in advance, ladies and gentlemen, you shall work with balance due. Balance due, second year. Balance due, second year. From second year. So currently in advance, you need to know to differentiate. In advance, you pick the balance due from second year. So the balance due is here from second year onwards. From second year to where everything from beginning, but once I pick. So hapa inakuwa 89, 778. Hapa inakuwa 46, 511. Hapa inakuwa 00 like that. Alafu nakuja kwa current liability. Current liability. So under current liabilities and gentlemen, under current, yeah, I can see somebody already following. So under current liabilities and gentlemen, in this case here you shall pick lease liability, lease liability, lease liability. You shall pick in this case here installment. You pick the installment again from second year, always. You shall pick from second year. So installment from second year. So installment from second year. Installment from second year. Don't take them as negatives. So 50,000, 50,000, 50,000, 0 like that with that. 0. 0. Yeah, use payments or it's the whole installment payments, yes. Installment payments, installment payments, installment payments, installment payments, installment payments. All right. So up to here, ladies and gentlemen, are we together? Up to here, are we together somehow? So again, this is a very, very important video that I would want you to rewatch. We are going to put it in our learning management system. In our learning management system, whenever you are watching a video that, of course, you had attended a class or whose concept you're very good at, what speeds are you guys using to watch my videos? Because you must always increase the speed. You don't have time. What speeds are you using? Yeah, abracadabra. What speeds are we using? Monica, 2 will be too much. 2 will be too much. 2 will be too much. 1.5 is very good. Monica, I know you are busy, but 2 will be too much. Or they're never uploaded on time. I'll be able to improve on that. Actually, what I'll do even myself, of course, I'm quite busy, but that's laziness on my part. I should be able to know how to upload this myself on the LMS. I should be able to know how to upload this myself on the LMS. So when I finish a class like this, I simply upload and everybody will be happy. Otherwise, thank you so much. So I'll be able to look at that replacement concept you guys mentioned. I'll go to WhatsApp and check your question. And that is very good. Whenever you watch a video and not able to understand a concept, always post that question there. Otherwise, thank you very much. Greatly, just go ahead and do your very best at your workplaces. Bye. Bye. Great. And of course, if there are new students who want to join us like today, because today was what year? Because today was a free session. New students who are supposed to come and join us, please call us 0719 525,000. 0719 525,000 is our number. Monica is asking a very good question. Mwalimu confirm whether we cleared impairment. That means Monica has not yet gotten my style of teaching. Remember, Mwalimu here, for example, this lease. Do you think Mwalimu will ever do lease question again during the normal teaching? No. So mine is simply to give you the loose ends, the tie-ups here and there, and then everything else, you'll get everything else in where? In the learning management system. And that's why we have left Sunday now open for you guys to do what you're to discuss and do things and watch videos. Because if I keep on doing one topic like thrice, we can't get anywhere. Maybe a disaster. Hope Monica answered you very well. We must rely a lot. Yeah, be blessed too. Be blessed. You will have to revisit Monica. You don't have a choice. Trust you me. You don't have a choice. I know you are busy, but you don't have a choice. Yeah, I will upload. This one I have taken it upon myself. I have to know how this LMS works. I must be able to put in the video myself. Thank you so much. Bye.